Herbert in Atlanta, and I'll be leading tonight. Then I'll go ahead and pass it over to Chitate to introduce himself as well. Then we'll go ahead and get started. Please, sir.
Good evening, everyone.
Good evening.
My name is KYITATIRE Dominique. I'm in Arizona. I'll be with you tonight.
Awesome.
I'm pleased to be part of the team.
Great, great, great. We are always glad to have you, Brother KYITATIRE. So as you can already see, I'm being on the East Coast myself in Atlanta. I'm on the East Coast. KYITATIRE is on the West Coast in Atlanta, rather in Arizona, Phoenix. So we are covering the whole geographical landscape of the United States. So if you're in the US, you're covered and represented even by geography. All right, let's go ahead and get started here. So we're officially starting this on a great start of a slide presentation. I'm going to be taking on, and my brother KYITATIRE will be following suit shortly after me. Let me show you this screen here. So we are talking about, and for those of you that got the invitation, we are going to be talking about financial instruments that we can use to positively impact our lives here in the United States. Or matter of fact, let's say in the developed countries, because some countries have the luxury of having these instruments. Some other countries not quite yet, even though we're pretty much sure that they'll get there as well. But being in the US, being in a developed economy, there are lots of instruments that we can take advantage of in our benefit, and not just benefit, actually betterment of life. So here we're talking about life risks. We're going to be talking about life risks that we have regardless of who you were, or regardless of who am I, tall, short, brown, dark, educated, illiterate, whatever. These are all risks that we all face as people, as individuals, as human beings. And how do we go about it? Or even better, how do we leverage the technology, the infrastructure in the nation, in the place that we happen to be, for our advantage? And that's the talk tonight. So much as I'll be presenting the risks of life, I want to propose a value. We are proposing value to those risks. And I believe we are good. We are in here for a very, very good ride. Let's go ahead and get started with the risk number one. We have a risk of death. A risk of death. And this is a matter of it's actually a matter of when, not if, because if for sure everyone will die, it's a matter of when will you die. You may die too soon, you may die at some point, but death is a fact and we can't avoid it. It's inevitable. The death of the body. Maybe if we go into our faith, that may be a different story. You could die maybe just by the body and not the soul, whatever, but the body would die for sure. And what happens when the body comes, or let me say, expires? Because there's an expiration date for everything. So these bodies will expire at some point, and we need to look at what can we do to anticipate a gentle exit, or an exit strategy where we exit out of these bodies that we have, that Almighty did put us in a sense that leaves our dependents, our loved ones, our families in a better shape. That's risk one. And the second risk is a risk of sickness. You may get sick along the way. Not necessarily dying, but still the body gets deformed here and there. There are lots of risks of our bodies that gets exposed to. So our bodies, not only death, they are vulnerable to lots of other diseases that are very, very, very certain to come along. And then the third one will be a longevity. When God blesses you with longevity, if you are to live too long, we all want to live too long, right? But when we live too long, it becomes a problem as well. And it's really interesting when we want this thing, but without really thinking about the con side of it. Just like, everything has a pro and con side, right? I don't know if death has a pro side. Most people think of death as entirely negative. Some people want to die. I think that's a pro part side of it. But with longevity, if we live too long, we are exposed to certain risks. Let me give you an example really quick here. When you outlive your productive capacity, you're in this capital fast-paced economy that has bills left and right, that has expenses that are optional and mandatory, both of them. And you get to a point where your body is waning, is kind of going down. You're not able to, move fast as you used to, do 2, 3, 4 jobs, or, work long hours, 8, 12, 15, 16-hour shifts. And the body gets, retards in its strength. You're not able to stand for long. So what happens in that case? How do we anticipate? How do we use? How do we leverage the instruments, the financial tools that we have in place today, so that those rainy days, when they come along, we are in a better shape? That's what we are proposing tonight. That's the value we're going to. The solutions here are the value that we are proposing. And as a matter of fact, if we can't agree on the problem, then it doesn't make sense to talk even about the solution. So if we agree on these problems, that they are certainly there, and we are all vulnerable to these 3 problems, then we have a discussion tonight. So let's look at the on the market in the US. As a matter of fact, in all 50 states, the products that are on the market that can be used to address these problems, that can be used to position us in a way, not just solve them, but solve them in the most creative and efficient way, to a point that everyone in their own capacities, financial capacities, knowledge capacities, they are still able to take a chip on each of these and have a solution, a strategy for their own, for their family, for their dependents. Now, the first one here, we have a product in the market that is called a term. Here, we are going to talk about a life insurance type of product. There are lots of financial instruments out on the market. But for tonight, let's talk about the life insurance and how can life insurance be used to address these 3 problems that we just talked about here. So one of the life insurance product that is on the market. So it's all life insurance, but then we go into types of life insurance. The first and most common type is called term, as you can see on the screen there. Term. So term is terminatable at some point. That's why we see here 10, 20, 30 years at most. It comes in portions, in time spans. You can take a life insurance, of only 1 year. It's called annual renewable term. You can take a life insurance of only 5 years. So it can go up to somewhere around 30 years. Just like you can't buy a mortgage of more than 30 years, right? You can buy a mortgage of 15 years or 20 years. But once you get around 30, it's capped. It's the max you can go. So with this term, or the other word, temporary, because at some point it's going to expire, it's usually cheap, very cheap. And we compare it to renting in an apartment. If you're renting, I don't mean to say here that renting is very cheap always, but the fact is, whatever penny, whatever dollar that you pay on rent, you forget about it. Even if you pay it right away and then you ask, that, or a portion of that money back from the landlord, it's hard to get it back. Simple fact. So yes, here we say it gets to expire. Mr. Fidel, can you please mute yourself? Thank you, sir. So we have the, yes, sir, thank you. We have the point of paying, and at some point it expires. This is not necessarily bad. Remember, I said everything has a pro and con. There's a positive side, there's a negative side of each. So we can see here term being cheap. You know, some people say, I think they get this analogy from the guy from Financial Peace University, Dave Ramsey, buy term, invest the difference. I think that's where they kind of find the positive side of term. But yes, term is term. At some point it may expire, and you may not need, you know, that coverage all that long. You may say, I feel like I'm I'm gonna die in 5 years, or maybe in 3 years. I need a coverage. They'll still give you a coverage there, but you can protect yourself. Why do we need to have life coverages? There are lots of benefits, but let me tell you one or two quick benefits there. Now, for those of you that are not in the faith, you know, excuse my language here, but for those of you that are aligned with the faith part, Proverbs 13:22 says that a good man, a righteous person, a great guy leaves an inheritance for his children's children. Not even children, just, you know, they go even 2-3 steps down. His children's children. Now, given the lifestyle that we live in the US here and in, you know, advanced economies, it can be pretty hard to leave that amount of money that will get to your 3rd, 4th generation down the road. So this brings in a creative way of leaving a legacy that will speak for you even when you are gone. That you don't leave your people, your dependents, your children, your spouse, your partner in a pretty bad shape, where they have to be evicted out of their apartments or houses or assets being repossessed. So it's one thing to leave, to lose a person, but it's the other thing to be better after the loss. So the proposed value here is you can literally pay a small amount of money and be sure that your life alone and the lives of your dependents, your wife, your kids, your loved ones are protected, not to be thrown in shambles when you leave. So we talked about this group term that people get through their jobs at their workplaces. This is actually tricky because I don't mean to say that it's completely negative and people should not go for it, but you should know the facts here. And tonight we're actually giving you facts. We're sharing information, the power of knowing. And then we're sharing information, and all we just need is you guys to be in the know and follow suit on that information, be it through your agent, your contacts, the people, either here or elsewhere. So group term at work, it does expire at some point, but there are other cons of it. The negative side is when you switch jobs at some point, or when you are laid off, or when you retire, you can't take it with you. Usually they give you some time to convert it, but if you do that, if you convert it after leaving your employer, the rates, the premium, the amount of money you're supposed to pay changes considerably into higher numbers. But with term, let's say you're taking a max of 30 years or 20 years, you can lock that rate for the entire amount of time that you're signing up for. Even if you switch jobs, you move between states here and there, up, north, south, east, west, you keep your rate locked for that long. So for the sake of time, I won't have enough time to dissect each and every point that I'm talking up here. I'm just stirring your mind and knowledge on these. And then we can have a Q&A at the end where we'll be able to address some of the questions here. So the second product is a whole life. As you can see, whole life. Just think about that concept or terminology in itself. It's a whole life. It covers your entire life. How do I know your whole life? Well, at some point, I know you will die, so that becomes your end point. So someone's whole life may go until 80. Another person's whole life may go until 98 or 100. So this type of insurance covers you up to the time you die or age 100. And this is how it's structured. You see this graph here or chart? I have a premium of $200. This is a random amount that I adopted. It could be $100 or $20 per month. This M is a month. And you're getting a benefit or a coverage or a protection of 200,000. Some people call it face amount in the industry here. That's the benefit or the death benefit or the face amount, whatever you would want to call it. But say you're paying a certain amount here on the right, on the left side, and then you're promised to get a certain amount on the right side in the red here. So the way whole life works, this portion will be split. Once you pay it, just like you pay your car insurance, the portion will be split into two. A big chunk of that portion, of that premium amount, monthly payment that you're making, will go towards buying your protection. And another portion will go toward your savings. Now you have a savings within an insurance policy, not on your bank account. Why should we have a savings account within an insurance policy? Because you're going to earn an incredible interest on that. That money gets invested. You paid it to buy your bigger protection, but now comes an added value of investing that money for you and get interest with it. Get some interest on top of that portion. It's only the portion that goes toward buying your cover, rather saving, not buying your coverage. So remember, you paid $200 in this example here. Maybe say 120 goes to buy this 200,000 for your death benefit, and $80 or whatever portion that remains goes into this CV, the blue part. This blue sign, these blue numbers here, that's the savings line. So CV is cash value there. Usually it gets, whatever portion goes in there gets about 3 to 4% in interest. And this interest is usually fixed, annual interest rate that you get to credited on the amount that was put in your saving. So the features here is the rate of return that you can see here. As you can see, 3 to 4 is, reasonably low. Why? Because it's a long term. It's going to be consistent. It's locked in for all those years for the rest of your life. When stocks go up, when stocks go down, you still keep getting the same consistent rate. So we say here, okay, yeah, it's good, but still the market is doing better. The market is giving me 10 or 8, 7% now, and you guys are going to give me 3, 4. But I got to think about the times when the market will correct, will go down. The market, the stock curve, it goes up, down, as we'll see shortly here. So if I'm in whole life, I know my money is protected against those trends of up, down, because I'm getting a fixed rate regardless of what happens with the market. And the CV, which is cash value, the second point here, it says it's actually not as much designed to help you whenever you want it. It's got to be there for some time. You got to leave it in there for some time, and then you let it grow. So you may want really cash when you actually have it, but still not able to access it on your account. Usually a rough 2 to 3 years to start with, and then the first RA years you get a portion of what you have in there, just so you don't close your account out. My third piece here is there's limited. We have some whole life policies that have limited living benefits. This ABR is accelerated benefit riders, where you can be able to cash that amount, the 200 that was promised you. You may be able to cash it when you're still living. Maybe say you did die, or as we'll see shortly with my brother KYITATIRE will tell you here, there are some cases where you're still able to get this money the death benefit, the 200,000 that was promised you, or 2 million, whatever, when you're still alive, not necessarily when you die. As most people think of life insurance, they think life insurance is all about death. I'm glad tonight we're going to learn a different perspective of life insurance where one is able to access that money without or still alive. Number 3, let's go on variable universal life. That's a different type of life insurance. But I mean, literally, let me tell you this. Remember we said term is like renting. A whole life is, the other word of whole life is permanent. It's like being in a house, paying a mortgage. If you're paying a mortgage, what happens is whatever amount you're paying goes out, yes, but you know for sure that a portion of that amount that you just paid will come back to you in equity. That's the asset you're building in the house, even though you haven't paid it out, but you're paying maybe say $2,000 every month, but you have a portion of maybe $500 or $300, $400, $500, $700 coming back your way at the time when you get out. So it's like being in a house. Now, with number 3 here, the one I'm showing you right now, variable universal life, it's a re-engineering of number 2, whole life. It's just been re-engineered in a sense that the only difference is these blue words. You see the blue words there on the screen? CV, which is cash value, this time is variable based on the stock market. So remember, in number 2, whole life, you were paying, say, whatever amount, 200, a bigger portion goes to buy your protection, and a small portion goes to saving. Now, with number 3, that portion that goes to saving is being invested directly on the stock market. So you can get more interest, but still you can get more losses if the market goes down. So it's no longer fixed like in number 2. Number 3 is variable, which is the exact opposite of fixed. And what do we see here? Look at this curve in between in this chart here. The red line, up, down, up, down. That's how the stock market goes. You know, for those of you that trade like we do trade on the market. You buy low and sell high. So when it goes down here, you buy when the stock goes down, and when it goes up, you sell. That's how they reap. That's how they reap you guys. For those of you that don't go to the stock market. But anyway, the point here is once you choose to go in the third one, you have more chances of getting higher interest when the stock market goes up, just like it's been doing nowadays, thank God. But then you have also the risks of going even lower and losing your interest that you had already accrued and the principal that you put in the first place, losing your money. So what do we say with this? Look at this side here. Number 1, we say this is very risky. If I'm maybe 20, 18, 25, I'll take more risks. I may, but you know, I'm not too old, of course. I think I'm about 21 now. I can do more. But for, you know, my friends here like Christian who are really getting to the age, sorry to call you out, Christian, but if you're getting advanced in age, you don't have much time left, so you don't want to take a whole lot of risk, right? You got to slow down on risk, so that way, if something was to go worse or go south, you still have something to keep for yourself. And those are things we get to walk you through as we structure these things for you when you're ready, looking at it with an objective. Then number 2, we say there are no ABR. ABR, remember, is accelerated benefit riders, a situation where you can earn this red protection money when you're still alive. When the market, within VUL or variable universal life, once the money is invested on the stock market, they restrict even your death benefit to a point that it's only death that can activate it. Some companies may be flexible enough to think of some other critical, maybe, no, not critical, terminal illnesses to trigger you to cash that money. And there's also a charged fee. Some fees could go high to charge you on that trend of the market. Number 4, which is the last one here, we are looking at index universal life. It's also a re-engineering of number 2. So basically, there's already, if you want to understand life insurance, it's either permanent or temporary, number 1 and 2. So 3 and 4 are re-engineering of number 2. Number 2, remember the interest was fixed. Number 3, it's variable. Based on what? Based on the stock market. Now, number 4, the interest is tagged on index. Now, I understand some of you may not be aware of this industry to know those concepts and terms and words of, variable, stock, index, whatever. The fact is, index is a combination of stocks. And that's why we're there. That's why you need to have an agent who can tell you all these things, who can dissect them for you. So look at that rate there. The cash value is now getting somewhere around 6, actually above 7.6%. That's what the index has been giving recently in interest. So let me talk a little bit here, and my brother actually, Chitate, thank you for coming on here again. He's going to take it up from here to talk more about this one. But with index, remember, number 3 was stocks. Stocks is a share of a single company. That's a stock. Now, when you take many companies, indices, each index has like 3, 4, 5,000 companies all combined into one. That's when you say, I'm an index. Consider examples of, you see, when you look at the, cable news networks, Fox, CNN, whatever, the stock market news, something like S&P, Standard & Poor, or the Dow, those are indices. So each of those combines thousands of companies in one, in a sense that if one company or 2 or 3 or 20 or 40 companies were to lose, to make losses, you have thousands of other companies that are still doing better. So that way, you're mitigating some losses with some great profits with many other companies. So that's why they are able to provide a higher rate, because the loss risk is really low. But remember here, you're not directly playing in the market. You're within life insurance. So you have a coverage. There are lots and lots of other benefits doing this through the investment of life insurance, not investing directly on the market where you are exposed to all the market risks. So look at the rates here. This is how the curve, actually, before we talk about the features of IUL or Index Universal Life, look at this rate. Higher rate of return compared to all these. Now, the cash value on number 2 is designed for you. You get much faster access to that money, the portion that goes in saving for you. You have a more faster access on that cash. You can cash it in, some companies even give you access to that cash within the first year, depending on the type of product you're buying. And then we have the free benefit riders. Free benefit riders. Those are that's the portion of protection that you're able to access. So remember, we're saying one portion buys protection and the other portion buys goes for your saving. Now, with IUL, you're able to even access the benefit, the protection, the death benefit amount. That protection, the face amount, this one red here, you're still able to access it when you're still alive. You won't wait until the time you die. And I will leave that one to Chitatile to explain it when he comes on ready. But my last piece before I pass it over to him. Let's look at these four products. How do they address the problem that we started off on? Look at the first one here. Number 1, it does affect term. I don't know if you can see this small red line here, but that's where it points out. Term solves death. Not like preventing it, but it mitigates the loss, the measure of loss at death. Your people can still keep some money, can get you can create a legacy when you're gone with term, because there's a death benefit that you're promised, but it can't help you when you're living too long, because there's no money kept in there. Look at whole life, number 2. Whole life goes to address death as well. Why? Because the low interest rate provided in the cash value here is not strong enough to cover your rainy days. You may keep some money in there, maybe, whatever portion, but if you live too long, that money wipes really quick, because it was a low rate, it had a low rate of return, and the compounding portion of it was not strong. I know it's a lot that I'm talking about here, but guess what? Just take the idea that these products are there, and you can take time to learn more about them with your own people, with your agents that understand the market and understand your situation. Let's look at the number 3 product here. Variable is very sure to address death. Why? When we talk about death, we are talking about this red amount, the death benefit. Death benefit. So that's very sure. But as analysts, we can't really solidly stand and defend these products to address long life. No. You will be exposed to risks if you are living too long while in these products, because the money may run out, may not be as much, especially when the market goes down. Now look at the last one here, number 4, which I'm passing it on to KYITATIRE. Number 4 is sure to address the point of death, the point of thickness, and the point of longevity. How can number 4 do that? My brother KYITATIRE, take it on.
Okay, let me take over from there. Okay. Tonight we are going to talk about IUL. I'm going to getting all parts of EAL. IUL is an index universal life insurance, which means that you don't have to die to be able to benefit this kind of insurance. You can benefit the insurance when you're still alive. This kind of insurance has 3 components. Let us dive in each one of the components. Let's say you die too soon. When you die too soon, people actually here, they think that having an insurance or health insurance, they have life insurance, which is not right. Because you may have health insurance, which we will be helped to pay your medical bills, your visits for the doctors, but will not help you to pay other expenses of your daily life. Here it's why it comes in life insurance. Let's say someone died too soon. If someone died too soon and they didn't get prepared, will not benefit for anything. But here, if someone died too soon and he prepared himself to support his family will having death benefits, tax-free money, which will cover all the expenses that the family has to go through when he's not there. I think we are together here. But someone who didn't do it, what will happen to his family? The family will have to suffer for maybe paying bills, paying school fees, paying other expenses for their daily life. So it's why we encourage people to think about this kind of policies, you know? And this is one of the EOL benefits. When you have that kind of insurance, you prepare yourself to leave a legacy for your family, and your loved one will be protected. Next. Here again, let's say someone gets sick. If you get sick, mean that maybe you have critical illness, or you have terminal illness, or you have critical illness. If you have such kind of disease, you have life benefits, living benefits. Those living benefits will be tax-free, comes from your life insurance, and the person that have that kind of insurance will have, let's say, life insurance of his first amount that he planned before. So we have to plan for it. It's why we are talking about all this kind of information, so that people will get ready to know what they can do in one of these scenarios. Next. Let's say someone also lived too long. Here, we have to think about when you live too long, means that as we get old, our immune system declines. And when it declines, we get more sick. We visit doctors more often. We no longer able to work because we don't have energy. And unfortunately, it's the time when you can't go to work to have an income. All those kinds, we don't have an income, and it's time when we really need it, because as we visit the doctors, as we don't work, it means that we need more support. What can we do? It means that we have to protect ourselves on the right time. So someone who have this, their benefits he can have already. If you have an ERL, or someone first can index his interest, his savings from the account will be protected, will be generating more money, at a high profit. And again, there is a certain rule called the rule of 72. I don't know if you know what it means, but it's like the interest you get will be compounded several times. Let's say you have a certain amount you put in a bank, and they promise you to give a certain interest of 6 or 10%. The compound interest will be to take that number 72, divide the number of the rate they promise you to the bank, and then the number you get when you do that calculation will determine the time you have to wait to compound the amount of money you put in a saving. But here, the money will be compounded several times, mean that you gain more money. Not only that, you can get your tax-free money and maximize the use of your advantage of creating more money, because you already have the index universal life insurance. So as we can see on the screen, the index universal life insurance has more benefits than the first three we have seen presented by Mr. Herbert. So at this point, if we look at the whole chart of the three components of the index universal life insurance, I think each of us can take action and see what is right to do to protect our lives and for our loved ones.
Thank you. Thank you so much, Mr. Chitatli. I appreciate you on that. Let's go ahead and get back here. Let's see. Any questions? We have about 8 more minutes to the top of the hour. Any questions, ideas, comments from what you just heard? I know it's been a lot of information unpacked in just one go. But yeah, if you want to ask any questions, and we'll actually provide our contacts, Chitatli, if you can go ahead and put your number in there in the chat box for those who want to reach out to you. And I can share mine as well in the chat box. But yeah, you can write in the box your question, or you can open up your mic and ask, please. Thank you.
Yeah, thank you, Herbert. Thank you, Chitatile, for good presentation. I don't know if it's a question. Just I wanted to say about index universal life, that it saves, as the Chitatile said, that it saves money than has a percentage than the bank has. Another thing, it saves and it protected. It provides like 3 parts. It divides your money into three parts. There is a benefit, there is saving. When you live too long, you get that saving, as he said. I have that question there. I can ask you, Mr. Herbert. Yes. Compared to the percentage of insurance and the bank, which is the highest than the other?
Jen, that's a very common question. People actually, it's legit. But then being legit, it's like comparing apples to mangoes in terms of the amount of interest. So the bank does provide some interest, yes. But if you look at the amount of money that the bank pays, or the rate at which the bank pays you interest, it's not even close to what indexes provide. Not even close to what you would get in a more conservative product like whole life, which is more conservative on risk, that pays somewhere around 3 to 5 and 3 to 4%. An index provides around 6-7% as of current. So the bank would give you just pennies. It would be it will not be ideal. Let me just say that. It will not be ideal to have your money at the bank where they will give you 0 point something percent. Or if you had, like, say, over 100,000 kept on an account where they may give you maybe 1% interest rate. Have you seen those pennies or cents that usually come on your bank when you have like thousands of dollars on your savings? That's the interest they are giving you. So yes, very curious question there. Most people have. It's not even close. You'd rather keep your money in an investment vehicle that, one, gives you a life protection. The bank won't give you a life protection. Insurance will give you a life protection, but also take it in investment where you get compound interest. You know, the most wise person ever lived next to Solomon was Albert Einstein. He said that the power of compound interest, that those who know that power, they earn compound interest. Those who don't know it, they pay it. And the right way to know about the compound interest here is to get it. And that's what we're talking about. With IUL, you get to get those compound interest. Okay, with life insurance instruments, if you're investing cash value life insurance, a cash value life insurance could be whole life, which was number 2 on the graph, or variable, which was number 3, or IUL. But for the most part, IUL does provide those 3 solutions to the issues that we started on, which is death, sickness, and longevity. I hope that answers you. And thanks, Jen, for bringing that one up because we've heard it a lot. Most people get confused around those lines, but it's really, really not even close. Banks provide very small amount if by chance they give you any of that. Sometimes they don't even give you anything.
Thank you.
I want to add on something.
Okay, go ahead, Chitate, then we can listen to Immaculate as well.
Okay, if Jen doesn't know or anybody else, they should know that the money we save in the bank, the banks themselves also get that money and put into the different policies to gain more money, and then they give us peanuts.
Exactly. So by going the IUL route, it's like you're taking that, you're being a bank yourself. Ima, go ahead. Welcome.
Wow, thank you so very much from both of you, Mr. Herbert and Mr. Chitatire. This was really an eye-opener. That's the beauty of sharing. We always say we learn so much every time we come here every Thursday. And there is a reason also they say there is a power in having options. Like Mr. Herbert was showing us, there are so many different kinds of life insurance out there, of which our people sometimes get confused. You feel like you have a term, you're like, oh, I'm good, my life is set. But because you have no information, which is why there is also, an advantage is in knowing, there is a power in knowledge. So you don't know the difference between a whole life or index universal life and a term. You end up actually wasting all your money on a term where you could have been able to get an IUL that will cover you for the rest of your life. Again, they always tell us that you can actually be able to cover all your life's what ifs with only one payment. The same thing Herbert again and Mr. Chitatire was telling us, the three what ifs. Like he was telling us the risks of life. You die too soon, you live a long life, you get sick. Again, we saw the only product on the market that is able to protect you and your family, again, is the IUL, the Index Universal Life. So thank you again, gentlemen. You nailed it for sure. So we need to do this more often because, again, our people sometimes fail to choose the right, not because they cannot afford, but because knowledge is lacking. So this was fantastic. Fantastic. Thank you again.
Immaculate, let me say this too. Our people always are confused between health insurance and life insurance. Wherever you tell them that, can I talk to you about life insurance? They will tell you that they have insurance, which is not solving their problems. Right. So they should try to understand the difference between life insurance and the health insurance.
Good. Yeah, actually, thanks for bringing that one up, Chitatire. Health insurance can't bring food on table. You will only pay your medical bills and you're risking to sleep on an empty stomach. So life insurance will, pay your bills, take kids to school, cover your mortgage, your property, whatever. And then health insurance will address your medical bills, which also life insurance can do. So life insurance can pay your bills as well, but health insurance cannot pay the other portion that life insurance does. So that's a big one to bring out at the end here. And I see we are running out of time here, but sure, if there's any pressing question, I know we were over by 10 minutes, or rather we started late over about 10 minutes. Maybe you can go over that just to get a full hour. But yeah, don't take any question back if you're here. If you have any idea, any inquiry or any add-on, please do. And thank you, Ima, for lighting out that one up.
Thank you, guys.
Yes, go ahead.
I can say something. I see many friends of ours here. I want to thank them to come to hear this thing. Life insurance, it's like saving lives. It's like saving people's lives. When you plan for your family, it's like saving them, not lefting them crying, thinking about how they can survive tomorrow when we are not there. And even when we are still there, There is a time you can't manage to earn money or to get something or to put food on the table. That's why life insurance is there, and you plan before. When there is a time we don't manage to go to work, as we go on shift and bring food on the table, life insurance can save for you. And at the end, you can be getting those food on the table. Many people in our communities here, they think they eat money of life insurance when they are already die. And they say, why they eat my money when I'm not there? No, you can eat your money when you are still. That's where they were saying living too long. Save your money, you're gonna eat it when you are still alive, not days. They say they can find their own money when I'm not there. I struggled myself, they have to struggle too. No, you have to save your future and save your family. Thank you, all people here who have joined.
Wow. Wow. That's a great
Thank you, Jen.
Yeah, okay.
I think we shouldn't add anything on what she just, mentioned there. Was that a conclusion you meant to?
Oh, just I was telling the people who are here listening about life insurance.
Good. Yeah, it couldn't be said any better. We thank you so much for that. Yeah, I'm gonna have to go ahead and close it off if no questions. I see lots of people. I don't know if Chor, Miss Chor, did you want to add anything? Because I saw your name moving around here. Maybe just because people are adding on or moving out. Chor, can you hear me?
I'm good. Nothing to add. You guys addressed it very thoroughly. Thank you.
Awesome. I'm so glad to see your picture there. I wish you had the camera on. But Roy, go ahead. Thank you, Chor.
Yes, thank you all for nailing it on the head. And we have addressed quite a bit of issues. The dying too soon, living long. In addition to living long, one of the things or the products that we have is the annuities. And that is something we would like to go in on the next time so that we dig deeper. Annuity is a contract which ensures that you don't outlive your money. We get you to invest your money into the annuity and you're able to enjoy that money over a time, given that we have been able to put some things in place, choose the right products for you. And these are the fruits that we have here in the Freedom Equity Group. Thank you, 21-year-old Herbert. Thank you, Mr. KYITATIRE. We'll get to learn.
Or you can call me Dominic.
Okay, Mr. Dominic. And thank you all who have been able to give us the rich information.
Yeah.
Thank you.
I yield.
Awesome. Thank you again. Yeah.